Morning, folks. Seeing you all after a gap of almost 2 weeks. But let's see what's happened in the last few days. I have Hiloni with us today to lend her insights on all that has been happening. Okay. So today's headline in the Mint says, small mid caps may face headwinds after April rally. And the numbers do look quite odd in the sense they're very uneven. The small cap index in the month of April rose up 20%, the mid cap went up 14%, and large cap went up only 7%. So that's a huge variation. It's not often that we see these kind of variations. And some of the reasons are, I'm sure we all have been speaking about the way FIIs have not been giving the support to the Indian markets, right? So they generally buy large caps. Yeah, so the whatever buying has been happening is because of the domestic support, and much more of the domestic support has been towards mid and small caps. So that's also one reason why we're probably seeing that large caps are not going up as much as the mid and small caps. But that also brings the question of valuations down, right? So when we're looking at the price earning multiples last, it does look at large caps are close to their long-term averages, whereas the mid and small still have a significant premium. Yeah. So is there any reason why we should allocate or not allocate to mid and small caps in this kind of a situation, Hiloni?
So, as we saw the war and the month, there was a lot of time correction and price correction which happened during that time. Of course, the markets have recovered as we saw from there. But what happened during that time is the valuations also came off. So, very expensive stock perhaps corrected a lot more. We were seeing one list where number of stocks which have corrected more than 40% from their 52-week high. So, this open select pockets and select opportunities for us to look into.
But the Q4 numbers came out pretty well. It surprised me, and it just sort of feels that the numbers have not discounted the pain that is going to be coming in this quarter and maybe the next quarter, largely because the input prices have not affected them in Q4, the rise in input prices. And the rise in input prices basically coming out of the rise in energy prices, and you know why. And that will all be felt, it will trickle down into the economy as we go through, with the food, fertilizer prices higher because of natural gas, and then coming down to food prices. Then also industrial input, energy is one of the largest inputs for manufacturing, correct? So this impact of inflation and cost price increases is going to hit us.
Yeah, and that's what we hear also from management commentary, where they have been saying that the impact has not been seen in Q4 numbers, but it will come through in Q1 and Q2 with a lot of, with most of companies and management also planning a price hike. So the impact will come through in Q1 numbers, and we won't be able to see it in Q4 first.
So if there's a price hike, the price hike may have the impact of reducing demand, unless it is an essential item or the brand equity is so high that price elasticity is there. Okay, so it depends who's doing the price hike, whether it'll get absorbed or not by the public.
Yeah, and also it also depends on if the company is passing it forward or absorbing the cost themselves.
If they absorb it without a price rise, then you'll see a margin hit.
Yes. Right? So either ways we'll be able to.
So yeah, so it does mean that in spite of the rally that we are seeing in April, and even if we do get some good news about the war ending shortly, the conflict ending shortly, the pain of the high oil prices of the last few days until the disruption sets right is going to trickle in over time. So any buying in mid and small cap funds, our stance remains the same. Don't be in a hurry, correct? Yeah. Let it spread out over the longer period of time like we have been. So no change in that stance.
No.
Excellent. Okay. And then what do we have there in the ET wealth, Hiloni? You have some colorful maps there.
Yeah. So we have been looking at heat maps of every time, right? So we had looked at an heat map a few weeks back, where we were looking at how different asset classes and allocation portfolio impacts the returns of the portfolio. Where we were looking at equity, debt, and gold allocation. That time, what we were saying is that gold is very structurally important to your portfolio, and how introduction of gold does change your portfolio outcome. Now in 2026 so far, that is the last 4 months, what we have seen is an equal weight portfolio, which is 1/3 allocation to equity, debt and gold each, has been the best performing at 2.3% of total return of the portfolio. But what is surprising here is also that in a 10-year period, an equity to debt portfolio of equity of 70%, debt 20 and gold 10 has been the best performing on 12.3%. But if you had 20% to equity, which is a much more conservative portfolio, with 60% debt and 20% gold, you would have made 10.2% in 10 years. Would you say the difference is not much more?
Apparently, yes. I mean, the difference between the best performer and the worst performer is only about 2%. But okay, 2% compounded over 10 years is a lot of money. Okay, so let's not forget that. But even the worst performing did a 10.2, which is amazing. So let's try to go into the depth of this and figure out how is it that the worst performing asset allocation over 10-year period still compounded by 10.2%. Okay, with only 20% in equity and the 20% gold and 60% in debt. How did this happen?
Yeah. So the core reason is that in the last decade, we have had outperformance from gold and has been outstanding. Although we have had periods of volatility, but in the last 10 years, maybe 2 calendar years, gold didn't do well. It did well. So if you just see the data from 2016 to 2026, gold had a CAGR return of 18.3% versus Nifty, including the dividends, which we call total return index, has done 14%.
So the last decade, gold so far, gold won the race.
Yes.
Okay.
Yes.
Do we know what happened in the previous decade?
So in the previous decade, again the same kind of story plays out, where gold had returned 13.5% CAGR versus Nifty TRI returned 12%. Marginal, but yet it looks significant.
But it's pretty significant that there was another asset class that did as well as equity, and something to be noted.
Yeah, with much less volatility and much more security in that sense.
Yeah. So while we are comparing with the Nifty 50, of course, you had the mid and small cap indices that did far better than gold.
No.
Is it? Yeah. So here we are only comparing with the large cap. It's still data that surprises us and never will cease to surprise us. I think that we had an asset class like this. Okay. And yes, my wife is going to be scolding me for this.
Viewers should be prepared for their wives also scolding them.
Yeah, and correct. Yeah. So I think before we come to that, Hiloni, okay, there was this analysis that we have done on flexi cap funds.
Yes.
Okay, so there's been so much being written about flexi cap funds and how they've been doing. So we did our own little bit of analysis. Yeah. So, and what we've come out with is this. Flexi cap is by definition supposed to be a mutual fund that can go into any asset class of equity size, whereas large cap, mid cap, small cap, doesn't matter. Okay, and so they're supposed to be very nimble and they can go anywhere based on the opportunity, and in our minds you're going to deliver the best return. But what actually happens? Okay, so the whole thought was what happens with flexi cap? Are they really nimble or not? Okay, so our analysis showed us some pretty interesting outcomes. The largest of the flexi cap funds, okay, where they're close to 1 lakh crore in terms of size, they have not been very nimble. Okay, they've largely remained in large caps in the region of 75 to 80%, always in large caps, and only about 20% they have been dabbling within mid and small caps. Okay, and whereas the smaller AUM flexi cap funds have been very nimble. They've gone down as much as 55% to large cap as compared to 75-18, the bigger guys. Okay, and the rest of the time, so they've been shifting from large to mid to small pretty easily. Okay, so shouldn't they have done better?
So what has happened is flexi cap has remained, as you said, in that large cap zone. They should ideally have done better, but what has also happened is for a less standard deviation or less volatility or less risk that you have taken, you have gotten rewarded lesser, returns compared to your, say, your large and mid or your multi-cap. Large and mid and multi-cap having more allocation to small and mid caps have actually done well and is a little more aggressive as well.
Okay. So the large and mid cap funds and the multi-cap funds have done better than flexi cap because they've been more nimble and got the cost right. But so that is something that we need to be having. But within the flexi cap universe itself, even though the smaller AUM funds have been nimble, they've not really delivered a higher return than the more stable large AUM flexi cap funds. So the shifting didn't really translate to a much higher return, or in some cases even a lower return. So while flexi cap will give you something better than a large cap fund, okay, don't expect that kind of nimbleness to give you an outsized return. But if you add a large and mid or a multi-cap fund to your flexi cap in the portfolio, that could deliver a higher alpha.
Yeah, and a better risk reward.
A better risk reward outcome.
Yes.
As compared to the nimbleness, which is why then let's see what I see Navneet Manod's photograph staring at me from ET Wealth.
Yes, so there was an article from ET Wealth where Sanket and Kezad has interviewed Navneet Manod, who is the MD and CEO of HDFC Mutual Fund, where he has been asked about the situation which we are in right now. But what comes out to me is risk management isn't an afterthought, it's the process. That's the headline here as well. So what I wondered was, how do you think about risk management, managing different risk profiles of portfolios for the last 25 years? I'm sure we have seen like 2 or 3 events in like 2 years span alone, but you would have seen a lot of events happening. And what did you do? How did you react to those black swan events per se?
Yeah. So Hiloni is just trying to imply that I'm much older, that I've seen so many events. But in wealth management, believe me, seeing more events is more useful.
Yeah.
Okay. So, well, at every crisis, what has held up is asset allocation. Okay. If we've been in the right asset allocation between debt and equity, between large cap, mid cap, and small cap, we have not had any reason to panic. The process of getting that right is very important. So if you start from the top, you first start with the right asset allocation. Process point number 1. I'm sure our friend Navneet would be happy to hear us as wealth managers also strictly following a process. Okay, this process of asset allocation depends on multiple factors. One is the number of years that the investor has to invest in, and the mental makeup. Okay, largely between these two factors, we decide on the asset allocation. We should understand how each of these asset classes behave over longer periods of time. Okay, how volatile are they? What have been their valuations? Where is it that growth can happen? Okay, so that's how you do this risk reward payoff. Okay, so if something looks more risky, is it also having a high probability of giving us a high return? Taking more risk does not translate to more return. We have to bust that myth. More risk does not mean more return. More risk means there's a probability of getting more return. If that probability is high, then you would like to consider it. If the probability is low, it doesn't make sense.
Is that where we look at the risk reward scatter plot of 3 year, 5 year, 10 years?
Yes.
To identify what the probability was.
Correct. So that gives us a very good clue as to whether the risk taken by the fund manager is translating to adequate return or not. Okay. And the second point is your signal charts. Where are these funds trending as far as risk return ratios pan out, right? We like to look at the Sortino ratio, and when you plot all these, we do look at the trends, right? How often have they been in top quartile? How often are they in the second quartile? And do they shift a lot between the bottom quartile and the top quartile? Do you look at the consistency of performance? And that always pays off. Okay, and that is why the set of funds that we eventually curate into a portfolio behave so well. They don't give us shocks.
So just as a thought, what happens if a certain mutual fund scheme, for the time being, or are overweight or underweight certain type of security, and in that particular event, it actually has a bigger drawdown, which is unwarranted for that MF, for that fund manager, for that AMC. Clients would panic,
Absolutely.
right? So I'm sure we also do.
Yes.
So how do we react to it, or how do we go about it?
Yeah. We don't panic. Number one. I've been nodding my head. We don't panic. It can happen that clients panic if they're counting day-to-day NAVs. It has happened that our favorite funds have taken wrong calls at times, and we have to forgive them for that, because you're looking at the longer performance, and nobody can get 10 out of 10 straight. If they're getting 8 out of 10 right, it's great. So that 2 or 20% times that they may take a wrong call can happen. And even just before COVID, for example, we had one of the best balanced advantage funds being overweight on equity, and they had the worst fall when the market fell during COVID, a balanced advantage fund. But that fund is one of our favorite funds and remains so. Apart from that one event, they've been very good all the other times. Okay. We've also had the event of one of our iconic funds, iconic flexi cap funds, with one of the most iconic managers. I don't want to name him, but one of the oldest managers. They had a horrible famine in performance for more than 5 years.
Oh.
Okay. All because they were overweighted in public sector banks or public sector enterprises for an extended period of time. It can happen to the best of managers. And that is where volatility of performance, if they have too many of these events, then it does mean that they are more volatile, or they're not as consistent as we would like them to be. If they're not consistent, does the payoff happen over a longer period of time? But the payoff may be only enjoyed by a few investors, not the larger ones. So that consistency is important for investors who are entering every day.
Yeah. So is there where the 3-year period to analyze or to observe the fund comes in from?
Yes. Yeah. So we need enough number of events. We need to see different cycles happen. So the longer the period we have to analyze, the better the insights.
Sure. So how quickly or how well they are recovering from the drop as well.
Yes. And also what changes have they made, and are the changes useful? Though these are more tactical in nature, we'd rather look at the longer term consistency and how frequent they are in the top 2 quartiles. Those give us a lot of insights. Okay. And the principle of incorporating risk reward ratios into a process should never be abandoned, in my view.
Yes, I agree.
Okay, that is what has held us clients' portfolios up over the last 25 years.
Yeah.
So I think this part of the process is very critical, and we should only continue to fine tune the process and not abandon the process.
Sure.
Well, that's all we have for you this week, folks, and looking forward to seeing you back. All right. Thank you, Hiloni.
Thank you, sir.